How is everybody doing? This is Bob Iacchino from Path Trading Partners along with my co-founder Mike Arnold. This is another in our technical tool series, technical indicators as applied to cryptocurrencies and traditional markets. We're going to cover the ATR indicator, which stands for average true range. So let's get started. The ATR indicator. ATR stands for average true range. The average true range indicator was developed by J. Wells Wilder in 1978. It is an indicator that measures volatility. Volatility is mean reverting. If you don't know what volatility is, you'll learn it in the course of this particular module that we're doing. The ATR is simply a moving average of the true range calculation. So what is the range? The range of a trading instrument is simply the high of the period minus the low of the period. So if a cryptocurrency or something else starts at 200 and goes to 220, 220 minus 200 is 20. The range is 20 units, 20 ticks, 20 cents, 20 decimals in terms of stocks, whatever it is. For example, if on the most recent candle or bar of a crude oil daily chart, the high was 50 and the low was 49, then the daily range would be $1, as I just described. The range gives the trader information about the volatility of the market. Large ranges mean high volatility and small ranges mean low volatility. Again, if you don't know what volatility is, it's just the expansion or contraction of a range. That's the measurement of the range and its expansion or contraction. So what is true range? True range takes into account gaps that occur between two bars. Gaps tend to be more present on daily bars, but can occur intraday if unexpected news comes out or if extreme volatility price action is present. True range is a better measure of actual market volatility than just calculating the range of a bar.
What is true range? The true range is the largest of the following calculation: the current bar's high minus the current bar's low, or the prior bar's close minus the current bar's low, or the current bar's high minus the prior bar's close. If the prior bar's close is within the current bar's high and low, then the true range will be equal to the current bar's range. Easier to see graphically. So here we have the prior bar's close on a candlestick. The next bar's open and the following bar's high and low, and the true range would just equal the high minus low. Pretty much the true range is always going to equal the high minus the low unless there's a gap involved. If there's a gap involved, then it will be different. So if the prior bar's close is 49, the current bar's high is 49.50, the current bar's low is 48.50, then the high minus the low is 49.50 minus 48.50, which equals 1. The high minus the prior bar's close is 49.50 minus 49, which equals 0.5. And the prior close minus the low is 49 minus 48.50, which equals 0.5. So the true range is therefore the largest, which is 1. Now, what happens if there's a gap? So we have the prior bar's close here. The next bar is open all the way up here, so you have a gap involved. This is where the true range comes in very handy because it does not just equal the high minus low. You can see if you were just looking at the range of a bar, which would be the high minus low, you'd still be looking at the high minus low of the second bar on this graphic. But however, there is a gap from the prior close to the open, so that is going to change your true range calculation. So if our prior bar's close is 47 and the current bar's high is 49.50, the current bar's low is 48.50, the high minus the low would equal 1 still. The high minus the prior close, which is 49.50 minus 47 equals 2.5. The prior close minus the low, which is 47 minus 48.50, which is negative 1.5. The true range, therefore, equals the largest, which is 2.5. Here we have a gap down. So the prior close is all the way up here on this bar. The next bar's open is down here. So we have a gap involved. So if we were just looking at the range, we'd still be looking at the high and low of the second bar. However, we're looking at the true range that has to take into account the gap. So the prior bar's close in this example is 50. The current bar's high is 49.50. The current bar's low is 48.50. So the high minus the low is still that 1, 49.50 minus 48.50. The high minus the prior close is 49.50 minus 50, which equals negative 0.5. And the prior close minus the low is 50 minus 48.50, which equals 1.5. The true range, therefore, equals the largest, which is 1.5.
Once the true range has been calculated, the ATR can be calculated by taking the true range for a series of bars and applying a moving average to it. Generally, 3 different types of averages have historically been applied to the true range: a simple moving average, the exponential moving average, and Wilder's smoothing method, which is his proprietary method, which we're not going to go into. The default moving average length is usually 14. When you open up a trading platform, usually they have it set at 14 if you open the ATR. Using a shorter length will cause the ATR to react more quickly to true range expansions or contraction. Using a longer length will cause the ATR to react slower and provide a longer-term view of the underlying's true range. So if you have a few days in a row that are a range of like 9 to 10, and all of a sudden you get a 12, that's going to obviously make it spike on a shorter range, but over a longer period of time, you may have more iterations of that, and it'll smooth a little bit more simply, be a truer representation of the long-term view. ATR and volatility. ATR is a good way to look at the volatility of the market. Volatility is generally mean reverting. Volatility does not have to revert quickly. It can stay high or low for extended periods of time. A lot of people make this mistake in trading. We've seen this in cryptos, where something stays high or stays down for periods of time. People think, well, it has to come back, and it really doesn't. It can stay that way for a long period of time. So here down at the bottom of this chart, you see the ATR, and you can see the ranges. Here's the low end, and then here's the high end. And throughout this particular period of time, this bluish purple line in the middle represents the mean. And you can see that it tends to pull back toward that middle. It is mean reverting, and it's represented so on this chart. The ranges have expanded. You've seen it go to the high here when the ranges got bigger. And then down at the bottom here, you saw some sideways movement. The range is lightening up, and then it expands again. But it tends to hover over time around its mean and revert back to it.
So ATRs and trading. Generally, ATR has been used in 3 ways to assist a trader in their trading: for trade entries or triggers, trade stops or exits, and trade targets. ATR entries. ATR has traditionally been used by short-term traders to trigger entries when the current price action has exceeded the prior day's close by some multiple of the ATR. The multiple of the ATR can either be larger or smaller than that of the ATR. For example, if the multiple is 1, a trader will look to buy the market if the current price action trades higher than the prior day's close by the amount of the ATR. If it was 2, then you double the ATR and add it to the close or subtract from the close. If it was 3, or you could do 0.75 or 0.5, whatever you test out. Conversely, a seller would sell the market if the price trades lower by the amount of the ATR subtracted by the ATR. Easier to see in a graphical example. So here's based off a daily chart. We're right here all the way on the far bar to the right. The close is essentially 34.34, slightly rounded up from 34.3398. So we're just calling it 34.34. The ATR on that day equaled 183. You can also see in this chart on the ATR, it's a 50-period ATR, giving more a stable representation and avoiding the larger and smaller term swings. So you have a general, more macro view of the true range instead of a very short ATR. So now we're going to take the prior day's close, which is here in the blue line. You sort of have a cross of a light blue line, which shows where the market closed, and the dark blue line, which shows the price it closed. You're going to add the ATR. We're just using an ATR length of 1. So we're just adding 1 value of the ATR, which was 183, to the prior day's close, which gives us this green line. And either a close above the green line or a break on it, people would look to enter the trade, just using this very simple trading strategy. Again, they could have doubled the ATR. They could have used 50% of the ATR. That's all testable in trading software to determine what works best for the markets you follow. Now, ATR has also traditionally been used to trail stops by keeping a trailing stop beyond the current price level by the ATR multiplied by a factor. If this is being done on an intraday basis, then the ATR will be based on the period the trader is trading. For example, if the trader is trading off a 15-minute chart, the ATR will be derived from a 15-minute chart. Then you're going to use a multiplication factor, again, that will be tested out to determine, am I using just 1 times the ATR? Am I using 1.5? Am I using 3 times? And most people generally settle on 1.5, 2, 3. So that means they could use 1.5, 2, 2.5, or 3 times the length of the ATR, and then they're going to trail the stop beyond that. Again, easier to see graphically. So let's say the trader enters the market long on this break above the blue line. Could be with an ATR system. It could be with another system. Doesn't matter. Their initial stop is down here at the purple line. Now, as it continues to make new highs, their stop is going to remain below that new high minus 2 times the ATR. That's their system, so they're using a factor of 2. And they're only going to move it up. So if it makes a lower high, they're never moving their stop farther away. Keep that in mind. Once the market makes a new high, that stop will remain in place until either it trades back below that purple line, which would then stop out the trade, or until the market makes a new high. So you see the initial stop moves up to the second level as it makes a new high. Then it trades sideways, comes up, makes a series of new highs, so the purple line moves up. Now, worst case that happens is if it were to trade back down that level, this trade would be stopped out roughly where it was entered. Then the market trades sideways, moves back up, makes a really nice new high, comes back down, comes pretty close to the stop, but does not get below the stop. Then as it trades back up, continues to make new highs. This is not showing every move of the stop up. This is just showing the major jumps. Makes another new high. Market comes down close again, then trades sideways, finally moves up again, makes a new high. Then you see this big red bar, closes above the level, but it broke through that level, and this trader exited the trade when it broke through that level. Then the market continues sideways. That trader is stopped out once that price level is broken. Now, some people do it on a trade through that level. Some people do it on a close below that level. This is just a different way that different traders can use to look these ATR stops and trailing them, so it remains a constant distance from the new highs. If you're going short, you just do it from the lows. How about for targets? ATRs for targets. The daily ATR of a market can also be used to gauge the trader's intraday targets. For a long trade, if the trader's intraday target lies beyond the day's lowest price plus the ATR, then the target may be too far away and should be adjusted to within the ATR range. For a short trade, the target should be within the highest high minus the ATR. Again, a factor can be used to modify the ATR. Common factors are generally between 0.65 and 1. So this is saying, look, I'm an intraday trader. Here's where my target would normally lie. Maybe it's based off some price action or some other systematic way of coming up with the target, but then it's verified with the ATR. And as it's outside the amount the market's expected to move or generally moves, then the trader might adjust their target closer, making sure they still have the proper reward to risk, and use that modification factor to verify that their target is more likely to be hit. Graphically, so traders entering along on a trend line break, their initial target was up at this red line based off their system. However, they then verified it with the using the ATR, and they were using a factor of 0.75. So they took the day's low plus 0.75 times the ATR, and their new target became the orange line here. And you see then they came up, and this is what happens many times with these kind of ATR adjustments. It doesn't get to the full ATR. It gets close, but then it just remains in that range for an extended period of time. So just an example, nothing we're recommending here, just showing you how it could be revised to bring it into a more likely target hit.
Use longer-term average true ranges to find the approximate mean ATR of the market. Use shorter-term ATRs to see how recent volatility compares to longer-term mean volatility levels. If using ATRs on intraday bars, use price data and ATR lengths that are suitable for the times and durations of your trades. For example, if trading during volatile sessions, do not use the ATR data that is heavily weighted to non-volatile sessions. The ATR is actually a very useful indicator. It can help the trader understand current volatility levels and see how the shorter-term volatility is relating to the longer-term volatility, and that can get you in and out of trades at appropriate places. It can help the intraday trader with entries, targets, and trailing stop levels. We've given very generic examples in this brief session, and traders should test ATR lengths and factors before attempting to trade with any of these concepts. It's useful, but in this particular video, you've got enough to be dangerous. You should do a little work on this. Again, we are Path Trading Partners. Follow us on Twitter at @path_trading and visit us on Facebook. You can see the /Path Trading Partners there. PathTradingPartners.com is where you can communicate with us. You can sign up for all the free webinars we have on there. You can get our podcast there, the Money Path Podcast, which can be found on the website. And please read all of our blog articles and all the stuff. Everything is on the website, along with our support email, which is support@PathTradingPartners.com. Leave a comment, hit like and subscribe if you like what we are doing, and we'll talk to you in the next video. Cheers, guys.